Chapter 9 deals with analyzing a project for risk and also calculating the appropriate discount rate to use for a project. Now, the espresso stand project is a good segue into Chapter 9. So, with Chapter 9, again, we're going to be analyzing risk. There are three main types of risk, or three ways you could view risk. You could view the risk of the project as a standalone project. So if it was the only project a company had, this is how risky it would be. It's like if you only own one stock, then your portfolio consists of a single stock, so how risky that stock is how risky your portfolio is. Standalone risk is the easiest risk to measure. We could also view risk as being within the entire firm, so within firm risk. So essentially, a firm is a portfolio of projects. So if you do one project and bring it into a portfolio of projects, it could actually diversify your firm some. And so total risk or standalone risk wouldn't be appropriate in that case. And then you could look at your firm as a portfolio of projects, and your firm is only one company that I might own as an investor. So I might own stock in 50 different companies, and those 50 companies have their own portfolios of projects. So as an investor, I would be most concerned with how that project would impact your firm's systematic risk relative to the market. So they would call that market risk. There are ways to evaluate market risk and within firm risk, but I'm not going to talk about them. Standalone risk, as I mentioned, is the easiest to measure, and there are a few different ways to measure standalone risk. The first one is called the break-even net present value. Now, if you think back to perhaps your first accounting class, y'all talked about something called the operating profit break-even. And the formula is you take fixed costs and divide by price minus variable costs. The problem with this particular equation is, well, actually, let me backtrack a little bit. What this formula tells you is the number of units you must sell to have an operating profit of exactly 0. The problem with this formula is it ignores the cost of the actual project. So for our espresso stand, to calculate the operating profit break even, I would take fixed cost of $13,000, divide by the price of $3.50 minus the variable cost of $1.25, which I'm just typing in because I don't have that in a separate cell anywhere. So that tells me for the company to break even in terms of operating profit, we would have to sell 5,778 units a year. And these are quoted on a daily basis, so that's why they're much lower than the value that's over here. Now the problem with this formula is it completely ignores that initial cost of the investment. It ignores the fact that I expect growth in subsequent years. It ignores depreciation because it only looks at operating profit, and technically operating profit occurs only after I've subtracted fixed costs and variable costs before I've subtracted depreciation. It ignores taxes on my investment. It ignores working capital changes up here. So the operating profit break-even is not a particularly good way to determine if a project is worthwhile. Let's take a quick look at this. Since we expect to sell 75 units a day, and we think we'll be open 360 days of the year, the company expects to sell 27,000 units that first year, which is far above the operating profit break even. And if I come down here and look at EBIT, which I labeled operating profit, but technically that's not exactly accurate. I should have not subtracted depreciation. I should have a row right here that I call operating profit, and I actually think I'll fix that. So operating profit would be my sales minus my fixed costs minus my variable cost. And then EBIT, which is just earnings before interest and taxes, but after deducting depreciation, I will just call it EBIT. And that formula doesn't change, it's fine. But you can see, since I expect to sell 27,000 units the first year, I've got a nice positive operating profit. But if I change this to 5777 units that first year, you can see that my operating profit is exactly 0. But I'm going to click undo. So I want to show you a better way of determining whether or not a project is expected to break even, and that is the break-even NPV. And it's essentially the number of units that I need to sell to have an NPV exactly equal to 0. And you know our NPV calculation looks at the cost of that investment. So it looks at the building and land cost and the cost of training employees. It looks at working capital changes. And it looks at depreciation and the tax benefit from it, and the taxes we'll pay on our profits, and as also terminal cash flows, so the fact that we expect we can sell the project for this amount in the third year. And the break-even, operating profit break-even formula ignores all of that. So what I want to do is essentially solve for this number, how many units I need to sell a day, so that my net present value exactly equals 0. And this will be for the first year only. The second year, I have equations in there, and I need to use that process to enlarge the font in my equation window, and I haven't done that. But you can see that my number of units that I expect to sell the second year hinge on the number of units I expect to sell for the first year if they can grow at 20%. And the third year, my expected growth rate is 25%. So if I change this cell, these two cells will change, and everything under it will change except for the price per unit. And I can use the goal seek, the goal seek function to do this. So I go to Whatif analysis, and I don't know, for some reason it's not active. There we go. I will go to the goal seek under data, Whatif analysis, and I want to set the net present value calculation to 0 by changing my number of daily units sold in year 1. And it tells me that I need to sell 15.64 units a day, and that would make my net present value exactly 0. So in terms of annual units, oh, actually I have that right here. In terms of annual units, I need to sell 5,632 units a year to make this project worthwhile. And since I'd originally expected to sell 27,000 units a year, then it's highly likely that this project would be worthwhile.